This is a Podfast summary of the interview between Bilyeu and Ray Dalio, discussing global cycles and the world financial situation. In the conversation, Dalio dives into the forces currently shaping our world and their implications on the global economy. He discusses the challenges faced by banks, pension funds, and insurance companies as a result of debt creation and money printing. Additionally, Dalio explores the rise of internal conflicts due to wealth gaps and populism, as well as the emergence of powers like China challenging the existing world order. According to Dalio, understanding the impact of these forces on financial markets and global events is crucial for investors and everyday citizens alike. Key idea 1. Too many assets and too little intrinsic value. Imagine a game of musical chairs. In a healthy economy, the number of chairs or goods and services and players or financial assets should be well matched. When there are too many players chasing too few chairs, aka intrinsic value, the game can become chaotic and unstable. Just like in musical chairs, when the music stops and everyone tries to grab a chair, those left standing are the losers. This can happen in the economy when people try to sell their assets at the same time to cash in on their value, causing a sudden drop in prices and potentially leading to a market crash. This imbalance between financial assets and their intrinsic value can occur for various reasons, such as excessive money printing, overly optimistic speculation, or artificial inflation of asset prices. A real-world example of this phenomenon was the collapse of banks like Silicon Valley Bank. These banks borrowed money to buy assets like government bonds, expecting their value to increase over time. However, when the value of these assets declined, the banks found themselves in a precarious situation, unable to pay back the borrowed money. As people became aware of the bank's financial difficulties, they rushed to withdraw their funds, leading to a bank run. The sudden surge in demand for cash further exacerbated the bank's problems, ultimately resulting in their collapse. To better understand and navigate this complex landscape, it's crucial to remain aware of the balance between financial assets and their intrinsic value in the economy. This awareness can help you make more informed decisions about investments and avoid being left without a chair when the music stops. Key ideas 2 and 3. Polarization and cycles of conflict. If we take a closer look at history, we see that conflict and crises often follow 10 to 15-year cycles. These cycles are like a disease with 6 stages, each one representing a different level of tension and instability. As the disease progresses to stage 6, the world becomes more turbulent and unpredictable. In the beginning, imbalances in wealth, resources, and power start to develop. These imbalances create tensions between different groups, as well as between nations on the global stage. As these imbalances grow, people and groups become more polarized, with opposing sides adopting more extreme positions. This can show up as political divisions within countries, or as geopolitical rivalries between nations. In response to these divisions, populist movements and leaders emerge, promising to address the imbalances that are fueling the conflict. Tensions between opposing factions continue to escalate, leading to protests, social unrest, and even violence, as well as increased hostilities between nations. Finally, the conflict reaches a boiling point, potentially resulting in social upheaval or even war. Eventually, the crisis subsides, and the process of recovery and rebuilding begins. However, over time, new imbalances can emerge, starting the cycle anew. Currently, we are experiencing a period of conflict and crisis, with internal conflicts dividing societies and rising powers like China challenging the existing global power structures. During periods like these, moderates often suffer. It's like being caught in the middle of a storm, with winds from different directions battling it out. Key idea 3. Financial and economic problems. Envision the economy as a juggler trying to keep multiple items in the air. These items represent various financial and economic challenges, such as high levels of debt, rising interest rates, and inflation. As more and more items are added to the mix, the juggler struggles to keep everything in motion. Eventually, he'll drop one of them, leading to negative consequences. Taking on debt can help with economic growth, but excessive debt can create major problems. Individuals and businesses may struggle to make payments, leading to loan defaults and bankruptcy. On a larger scale, government debt can reduce investor confidence, resulting in higher borrowing costs for the country. Interest rates are a key factor in the economy, influencing borrowing costs, investment decisions, and consumer spending. When interest rates rise, borrowing becomes more expensive. discouraging businesses from expanding and individuals from making big purchases such as homes and cars. Central banks, like the Federal Reserve in the United States, adjust interest rates to manage economic growth, control inflation, and maintain financial stability. In the current cycle, we've seen periods of low interest rates to support economic recovery, followed by the potential for higher rates as economies rebound and inflation becomes a more pressing concern. This shift can create uncertainty for businesses, investors, and consumers as they adapt to the changing financial landscape. To navigate the evolving interest rate environment, businesses and individuals should prepare to adjust their financial strategies. For businesses, this might involve optimizing cash flow, managing debt levels, and reassessing capital investments. Individuals should review personal finances, evaluate their outstanding debts, and consider the potential impact of rising rates on mortgage payments or other loans. Another economic challenge is inflation. Moderate inflation is generally considered healthy, as it encourages spending and investment. On the other hand, high inflation can erode purchasing power, making it harder for people to maintain their standard of living. It can also destabilize the economy, as central banks may raise interest rates to combat it, worsening the problems mentioned earlier. Key Idea 5. Purchasing power over safety. To illustrate this idea, think of yourself in a rainstorm. The storm represents inflation, while your umbrella symbolizes your investments. You need to find the right umbrella to stay dry even during a heavy downpour. Some investments, like treasury bills, are traditionally considered safe because they have a low risk of default. However, if these investments don't provide returns that keep up with inflation, they're like an umbrella riddled with holes. It's crucial to select investments that can provide returns that outpace inflation. This might involve diversifying your portfolio with a mix of assets, such as real estate, commodities, or cryptocurrencies. Real estate can offer diversification benefits, as it often has a low correlation with stock and bond markets, which means it may perform differently under various market conditions. Potential investments in this area can include buying properties, investing in real estate investment trusts, or participating in real estate crowdfunding platforms. Commodities are physical goods, such as gold, silver, oil, or agricultural products. Investing in commodities can provide a hedge against inflation and currency risk, as they tend to hold their value during times of economic uncertainty. You can invest in commodities through futures contracts, exchange-traded funds, or through the stocks of companies producing and trading these goods. Cryptocurrencies, such as Bitcoin, Ethereum, or Monero, are digital assets that operate on decentralized networks. They have gained popularity as an alternative investment due to their potential for high returns and low correlation with traditional asset classes. However, they also come with significant risks, including high volatility and an uncertain regulatory landscape. You also need to stay proactive in monitoring your investments to stay ahead of inflation and changing economic conditions. This might involve reallocating your portfolio, seeking professional advice, or exploring new investment opportunities as the market changes. Key Idea 6. Diversification. To understand Ray's advice on managing your investments, let's use the analogy of a well-balanced meal. The meal is like your investment portfolio, and the various food groups are different types of assets or investments. A healthy, balanced meal contains a mix of proteins, carbohydrates, and fats, along with vitamins and minerals. Similarly, a well-balanced and diversified investment portfolio can provide a strong foundation for your financial health. Just as you need to consume enough calories to fuel your body, you should have enough savings to create a solid base for your investments. This might include setting aside an emergency fund to cover unexpected expenses, or establishing a cash reserve to take advantage of investment opportunities as they arise. In a well-balanced meal, you wouldn't want to consume only one food group. By diversifying your investments across various asset classes, industries, and geographic regions, you can reduce the risk of your portfolio being negatively affected by any single investment or market event. This can help protect your overall financial well-being, even when some of your investments underperform. Thank you for listening to this Podfast between Bilyeu and Ray Dalio. If you enjoyed this content, please like and subscribe. See you next time.